Hi, everybody. Welcome back to Wade into Wealth. I'm Chuck Wade. My brother Ethan is here as well. Wherever you're finding us today, be it on YouTube, Apple Podcasts, Spotify, the World Wide Web, we're thankful and glad that you're with us. Small ask before we get started today. If you find value in this podcast or think of someone else that may find value in this, please share it with them. Leave a review. Pass it along.
Click subscribe.
Click subscribe. That helps as well.
Mm-hmm.
Any way to get the message out there, it is completely free. We are literally doing this out of the goodness of our hearts, and I think because we enjoy it most of the time.
Yep. That's
yes.
right.
No. It's good to be here with us. So today, worst investing advice you've received.
Are you asking?
Sure.
Me?
Asking.
Yeah.
And it'll be the topic we cover today.
Usually, I feel like it ends up being centered around like some stock that someone has purchased and it happened to work out for them, and because that's the case, it means it should work out for everybody else. I don't, to be honest, most people don't give me investment advice.
That's true.
So nothing really.
Worst you've heard.
I don't know that this is the worst I've heard. It comes up a lot.
Yeah.
It's something that I'm not, the biggest fan of, and I suppose a case could be made, but for me, I just have a tough justification of it, which is, and this may come up with you.
Mm-hmm.
Interest rates are low, so should I borrow money on my home equity line of credit and invest it because I can get a better return? It's probably not bad advice. It's just I have a hard time taking on debt to invest.
Mm-hmm.
Because one thing that's guaranteed is you have to pay the interest rate.
Yes.
That you're being charged. And another thing that certainly is not guaranteed is any return from the stock market.
No.
Now, long term, good quality stuff should work out fine. But for me, and it's probably more a psychological thing, and maybe I'm missing the boat on it. I have a really hard time justifying taking on debt or leveraging yourself further to invest money because you are guaranteed to have to pay the bank back.
Sure.
You're guaranteed to have to pay the interest. The stock market isn't guaranteed to give you everything.
No, and
anything, not everything.
No, and so then the question there becomes, what happens if the market goes down? What happens if the market tanks? Because now
you still have to make your payments.
You still have to make an interest payment, so there's that. But at the same time, now your money that you would have used for an expenditure is less. So the money that in theory you could use to repay that debt is now less. And so now you're concerned. Now you're second guessing the decision that you're made. So now the door is even starting to creak open for making another poor decision, which would be panic selling. Do I panic? Do I pull this money out and have 20% less than I started with on a debt that is costing me 6%?
Yeah, and
not
I see
a great position.
In fairness, I see the logic.
Sure.
If you can borrow money at 3.5%, 4% and invest it to seek, keyword, not get, but seek, 7, 8, 9, 10% over the long term, I get it. I see the logic. I just struggle with and I probably shouldn't. It's not the worst advice I've ever heard of, but I struggle with the idea of taking on debt, leveraging yourself further just to invest money. Well,
taking on debt is basically you are allocating, it costs you time and resources in the future. So you are saying, well, all right, well, I'm going to not pay for this necessarily now, but you will pay for it in the future, literally.
And it also reduces your option that when times do get tough and the market tanks, if your home equity line is tapped, that's one less option that you have to be able to access in the time that you do need cash.
Yeah. So these are good conversation points, though. Anytime something like this comes up and you're having a concern or a question about what's the best way to finance a purchase or something along those lines, call and ask someone that you trust.
Yeah.
It's a lot easier. It's much better to have a sounding board.
Because it usually these conversations usually start with, I've heard or someone told me, or
well, that's
my
where
best
I was
friend
going.
Or my cousin or my child told me about this investment idea, and if they're doing it, it must be the right thing for me.
That's usually where not great. That's usually where the not great investment advice starts. When
very technical, usually not great.
The usually not great. Well, trying to be a little diplomatic here, but you'll hear it. Someone comes in and it's, well, my friend told me, or I've heard, and I almost cringe a little bit because, okay, what's coming?
Yeah,
my friend told me,
and if I'm sometimes relieved if it's like, okay, yeah, that's actually a good that's a good company.
Sure.
That's a sound business. Okay. As long as it's not something. I cringe when I see, type in the symbol and it's 30 cents or $2
So
a share.
to give you a scenario, I'll hear, well, my friends told me that I need to be invested in this, or my friends told me I should be investing in this. And my answer to that is, what do your friends truly know about you and your own personal financial situation? And what do you know about your friend's personal financial situation?
Right.
How much money do your friends have? So they're telling you should be investing in XYZ company. Well, how much money do they have invested in it? How long have they been invested in it? How much money do they have invested elsewhere? How are the rest of their assets structured and set up?
If they have $2 million and they have $5,000 invested in this wildly aggressive investment, and you have $100,000, it probably doesn't mean you should go put half of your money in that investment.
Right.
So there's perspective. But to your point, you don't know.
No.
You don't know about that. And then it's like when you hear someone coming back from the casino, you often hear about what they've won.
Yeah.
But usually if they've lost, maybe the comment is, we held our own.
Right. Nobody talks about their losses.
I'm holding my own.
Right. Right. Yeah. No, and we've heard this a lot. I mean, we're in Rochester and upstate New York where people say, well, I had somebody, they own Kodak stock.
Yeah.
Well, again, what else do we know about that situation? Because, yes, Kodak did go into bankruptcy. Shareholders were certainly hurt. But how long did said person hold on to the Kodak stock? How much did they actually have? There's all these. Usually when I hear my friend told me, there is some re-educating that has to be done. Because when we get into making comparisons without all the pertinent and relevant information, good things don't usually come of it.
No, and it's just your circumstances should dictate what investments make sense. And, no two investors are the same. Your risk tolerance, your appetite for risk, the ups and downs of the market may be different. And just because something worked out well for somebody else doesn't mean that from that day forward that has to be a good investment.
Right.
And that it absolutely makes sense for you. I mean, the reality is sometimes you could get lucky. And something that maybe isn't the greatest investment may work out really well for that period of time. But from a long-term stretch, maybe it settles back down to earth. And if you buy it after having missed out on that big boom, chances are it may not work out the best.
Yeah, friends rarely tell friends about their investment losses.
Right.
Keep that in mind.
Yeah.
Keep that in mind. How about this one? Buy low and sell high.
Yeah, I mean,
I love this one.
But that's what we always want to do. But the reality is, to me, it's a bigger conversation about timing the market.
Yep.
Which is, we tend to see this where did we, before the market's going to go down, will you call me so that I can sell all of my stocks? And then on the flip side of that is that right before it starts to go back up, will you call again so I can buy them all back? It doesn't work that way.
Right. Because we don't know.
Not if you want a proven, repeatable process of being able to generate consistent, emphasis on long-term returns. Warren Buffett, perhaps widely considered to be one of the most successful investors of all time, doesn't try to time the market.
He's really just been one of the most patient investors of all time.
Exactly. You talk quality and patience.
That's it.
And it works out pretty well. That is a proven, repeatable process that can drive long-term returns. But he's very much well known for saying it's not about timing the market. It's about time spent in the market. And that's very real.
Yeah.
It's very true. Because timing the market, both trying to get out and trying to get in, is just a guess. And I don't know about you, but last time I checked, our clients don't come to us to leave the feasibility and the well-standing of their retirement up to a couple guesses.
No, or a couple of tosses of a dart.
Right.
Absolutely not. Absolutely not. And the reality is what often happens when it comes to buying low and selling high, what typically happens is that when emotions get involved, we sell at lows and buy at highs. Right. And a great example would be the Great Recession, back in 2008, or even more recently when COVID became a thing in March
of 2020.
and the market drops 35%. Well, nobody thinks of selling their investments when the market's dropped 5%. Very few people do. Very few people notice that. But when it's dropped 35% in a month and a half, well, now all of a sudden you're starting to think, what should I be doing? And the reality is, if you're thinking of selling your investments at this point, it's too late.
Well,
it's too late.
I mean,
well, it's not too late.
It's not too
you
late,
can sell
but
them,
you should.
But now
perhaps your mind should tell you that you might have missed the boat.
Might have missed the boat. So, but let's say that you did. And so what then happens is, well, I got to wait for things to calm down.
Mm-hmm.
And we've seen throughout history that typically the biggest days of any recovery from a significant drop in the markets come within the first 14 days of the bottom being hit. Now, what we don't know is, where's the bottom? We don't know.
No one knows. Yeah.
But again, so you say, well, I got to wait for things to calm down, wait for things to get a little better. So you wait, and the market starts to recover, and you wait, and you wait a little longer, and by now you're starting to think, well, did I miss it? So what should I do? Do I either wait for it to come back down, or now I'm comfortable, but that 35% has been in large part made back over a period of time.
Mm-hmm.
And so now,
I mean, we saw within a handful of months last year that folks who stuck it through had made their money back in a handful of months.
And we're profitable. If you look at 2020, from calendar year, from January 1 to December 31st, the market was up, I think, about 14.5%.
A lot of heartburn along the way.
Right. So, but if you just look at it from that, so pretty good year. Now, if we shrink that window down and look at it from the second week of February to the end of April, you say, oh my gosh, what a dumpster fire this has been.
Well, it's been the worst year since the Great Recession in 2008.
So it's all based on the time frame that you're looking at it. If you're looking at it over a wider view, you get a better picture, but you don't know what's happening along the way, and that roller coaster got pretty scary February, March, April.
Yeah, and I think CNBC kind of feeds into this stuff.
Kind of?
Yeah,
I don't think they kind of feed into it. They absolutely feed into it.
It's the idea of I'm going to get in and out of this, and I'm going to, the concept of selling the market. I mean, they are an entertainment show.
Yeah, no,
right? They deliver news, but they are an entertainment show as well. And the talking heads talking about getting out of this. You're going to have a 10% pullback. You're going to go and get out of this stock and get into this one, and then go back and buy it down because of buy it again because of a specific trading range. The reality is you want to make real money, and I bet the people on CNBC would probably agree with this.
Sure.
You want to make real money, hold good stuff over time.
And leave them alone.
Yeah.
You know, nobody has ever said on that. Well, I shouldn't say has ever said, but I would be shocked to turn on the TV and hear someone on CNBC say, well, I bought this company 12 years ago. I've held on to it. It's kind of boring. They make, relatively boring product, but I've quadrupled my money over that period of time.
Yeah.
Nobody talks about that because it's not interesting. It doesn't get people to click on the story, and it doesn't get people to keep listening after a commercial break.
Right.
What is interesting is, hey, what's this trade? It's all a trade.
Yeah.
It's all a trade.
Yeah, it's a trade.
Everything, most of what you see on financial news or networks is about a trade. Well, this is down. You should buy it and then sell it here. It's a trade.
And our focus
Are you trading or are you investing?
Well,
are you trying to make
at it as
quick
we're building
profit,
wealth,
or are you creating wealth?
We're building wealth over time.
Because they're different things. So let's talk about that, though, because this is an interesting concept. And the idea, I think, that you need large returns over a long period of time to be successful in investing. True or false?
Oh, false. I mean, with the definition of large returns over time, I mean, I think you
let's say double-digit returns. You need to be consistently hitting double-digit returns.
I don't think you need that. I mean, the law of 72 says that if you just average a 7% average annual rate of return, you double your money every 10 years.
Yeah.
I mean, technically 7.2% average annual rate of return. You double your money every 10 years without putting any money in or taking any money out. And so that's not a double-digit return. But if you looked at someone who was in their 20s, 30s, 40s and said, you're in your 50s, you're gearing up for retirement, and you're thinking, I got to really start socking some money away because retirement's 10, 15 years from now. If you're just getting that average return of 7.25%, you'll double your money every 10 years.
Yeah.
Not a lot of sizzle to that.
No.
But it should be a focus on just good quality stuff that also should come down to your circumstances and what you're trying to achieve.
Yeah.
Money and investments are a tool. to fund the retirement and the life that you want to have.
So instead of asking how much can I earn, what we should be asking is what kind of return is sustainable for me over a long period of time.
Yeah, and what do you need?
And what do you need? And, I go back to, well, you talk to your friends. People will tell us, or in social situations, someone will say, well, I made 18% over the, I'm like, 18% last year. Okay, great.
Yeah, cool.
Like, that's great.
Yeah.
Good for you. People like to talk about that, but the reality is that we should be asking ourselves, what kind of return can I sustain over a long period of time? What kind of
and
returns?
chances are it's not 18%.
No.
The
It's probably
S&P
high
500
single digits.
Well, yeah. S&P 500 since I think the 1940s, average annual rate of return probably about 12% a year.
Yeah.
Maybe a little more than that now.
Which is really good consistently. But we also have to ask ourselves, what kind of portfolio of investments can I hold that will allow me to be patient and not make emotionally driven decisions?
Right.
Because when you think about the long run, okay, we talk about long-term time frame, the long run. The long run is really a bunch of short runs placed together.
Mm-hmm.
And what we mean by that is, well, if we say long-term, it's easy enough to think that, but it's not as easy to actually live that in action. With an example being what happened in 2020. Well, how'd you make it through that short run of stress, of chaos, of anxiety in the markets being down 35% in a month and a half?
Focusing on the long term?
Right. But easier said than done.
Sure, yeah.
Because you have to make it through that short run to be able to get to the long term. And somebody put this really eloquently, and I thought this was really interesting, is that long term is an agreement between two parties. So in our case, it would be an agreement between us and our clients. When we say, well, you have to be in this for the long term, or when you're in the middle of a period of chaos, and we're saying, look, now is the best time to be patient, take your hands and basically sit on them for a while. Let's not make emotionally driven decisions.
Yep.
The agreement has to be also from a client who is willing to accept that advice and enact it.
Yep.
Because it doesn't matter if we say, well, here's what you should do, and someone says, okay, great, but I'm still going to panic.
Mm-hmm.
If we can have that agreement that here's what we need to do, this is our plan, and our clients can hear that and say, yes, that makes sense. Okay, let's do that. Then long-term works.
Yes.
It's an agreement in a way that we make with each other.
Yes.
Or that you make with yourself.
Yeah.
So
it makes it easier to deal with the heartburn that comes with the short term.
it sure does. And it will come. It will be here. Yes. It is unavoidable.
Yes,
that
you heard it first.
Chaos.
There will be market crashes. They will happen.
Yeah, absolutely.
What we're not saying is it's not happening. We're not saying it will or it won't. Won't happen next week. Who knows?
I don't know.
No one knows. The reality is the market doesn't crash because everyone saw it coming.
No.
Right? It crashes
Doesn't
because
work that way.
some piece of news just came out or some reality just came out that no one foresaw.
Right.
And that's why it crashes. Right?
Yeah.
Because when everyone sees it coming, it's not a crash.
Yeah, and I think of this, we're both parents of young children, and I think we can end with this, but so we have kids. Something happens. Griffin's playing in the driveway. Griffin falls and gets hurt, and he skins his knee. Now, he's crying, possibly crying.
Mm-hmm.
Tough kid, but he's crying. He wants his mom. Okay? Yep. He's unhappy.
Yep.
Stock market does that all the time.
It does.
The stock market falls and skins its knee.
Yep.
And you can look at your son as your parent, or I can look at Charlotte and June and be like, well, I know they're okay.
Mm-hmm.
They're in a little bit of pain right now.
Yeah, sure.
You give them a hug. You pull Boo Boo Bunny out of the freezer. You put it on there, and, they're okay. In a couple minutes, they're running around like nothing ever happened.
Mm-hmm.
That happens all the time in the markets. There are hiccups. There's bad news, and the market drops a couple of percentage points, and it looks ugly for a short period of time.
Right.
Now, every once in a while, though, a bone is broken, or something happens that's a serious issue. And maybe you got to go to the hospital, or you have, I remember when our daughter, Charlotte, broke her clavicle. All right. She's in a sling for a while. Mm-hmm. That's painful. That is altering the way that she lived her life for a period of time.
Yep.
You have to make some changes. You have to look at it and evaluate, is there anything we need to look at possibly doing differently here? But you don't stop living your life.
No.
Right?
You shouldn't.
You shouldn't. Every once in a while, you get a scrape. There's some short-term pain. You move on with your kids. And they're okay. every once in a while, something happens that's a little worse, and you got to find a way through it. But you don't just panic and stop everything.
But to your point,
and not address
whatever Charlotte was doing when she broke her clavicle, you're not just going to go put her in her room and lock her in her room for the rest of her life.
No.
You're going to get through it. Life continues on. It happens. And you've got to stick with your routine, because you also know if you put her in a bubble and you lock her up in her room, that's not going to allow her to go have the life that she should have, or that she would ultimately want to have.
Well, she'll be safe from breaking her clavicle again, but she'll have no experiences and really no quality of life.
Yeah, which that sounds like a fun retirement, right?
Right. No, it doesn't.
Stay in your house, don't leave, and don't spend any money.
Yeah.
Not the retirement that I think most of my clients want to have.
No. And with patience and time, most of these fallacies can be very easily avoided.
It's a beautiful thing. Yeah, really is. Simple.
Not easy.
We talked about Occam's razor this morning.
Yes.
Which is just that usually the most logical conclusion and the simplest of solutions and plans is the best path forward.
Yeah. Action item. I've got one. The next time someone, a friend, gives you investing advice or tells you about some great investment they have, that's great. You can be happy for them. Step back for a second and ask yourself, how much do they really know about my own situation? And when's the last time they told me about an investment loss?
Mm-hmm.
Chances are that's a conversation that hasn't yet been had, and there's a reason for it.
Or maybe they're just holding their own like they do at the casino.
Maybe they're holding their own.
Yep.
All right. Well, I think we got it covered. That's Wade into Wealth this week. As we get into fall here, stay dry, stay warm, and we'll be back next week with more on Wade into Wealth.